We are back to everyone's favorite topic, Tesla. Woo! Give me some of that Tesla. Is this Tesla stock forming a top right now? Should Elon be worried? Because you know what happens after tops, right? The downfall, the crash, potential crash, of course. But that's what we're going to talk about in this video. And I'm fine talking about Tesla all the time because there are a lot of lessons that we could learn from this one stock and how people react to it. Now, I personally don't care if it crashes or not, apart from the fact that, I really want Elon to win in whatever he's doing. But in terms of my own portfolio, I don't care because we've been taking profits and managing risk this whole time. So even if Tesla did collapse, it'd be all right. And as always, if you want to learn more about how we manage Tesla and how we just, run our strategy in general, same strategy I myself and a bunch of our Fallible members use, then definitely check out this free training. You can see there's an example of Tesla right here. But there's a link to that training in this video and down below in the description and comments. Definitely take it. It's free. You got nothing to lose and everything to gain. So there's been a lot of bearish theses lately. Theses as in the plural of thesis, as opposed to theses. I mean, there's always a lot of Tesla bears, but I feel like the bear cases just grow as the stock grows. You would think it'd be the opposite. If Tesla is going up, oh, okay, maybe the bears were wrong. But no, they just dig in and get stronger. So let's talk about why most of the bear cases don't matter. First one being, the biggest one that I always hear is valuation. I've been hearing that from some popular YouTubers as well. And they're talking about valuation in terms of the PE ratio, which is the price to earnings ratio. And if you try to use the PE ratio in the most basic way, then you could say that, hey, a higher PE ratio means the stock is more expensive because the price you're paying per earnings is very high. So you're paying many dollars for each $1 of earnings. So that's the theory, but of course in practice, PE ratios don't actually work like that. For example, tech companies are usually going to have way super high PE ratios. And my argument is that valuations and PE ratios don't really matter in the first place. And the reason I believe that is because valuations are purely subjective. Who cares if a stock is at a 300 PE ratio versus a 400 PE ratio? What's the real difference there? How is that even properly fitting into your model? Because at the end of the day, valuations are just based off the people who are investing in the stock. More than anything, it's supply and demand. Why were they able to sell pet rocks in the 80s, or was it the 70s? I don't know. Because people placed value on this thing and that guy got super rich who was selling them. Did those rocks actually have more value than the rocks you could find everywhere? I guess they did because people paid money for them, right? There was demand and that's what pushed the price up. And if you want another example of stupid valuations that is very relevant to this example, you can look at this. You guys remember this piece of art? At least they called it art. It was a banana taped to a wall and it sold 3 consecutive times. First for $120,000 and then finally for $150,000. And those numbers for a banana taped to a wall are extremely offensive to me as a person of Indian descent. He paid how much for this banana? What? We're cheap as it is, but $150,000 for a piece of duct tape and a banana? Really, Indian or not, it should offend all of us. But what's interesting is that the market is basically just like this banana. Oh, and of course, the best part about this banana story is the other artist that walked in and ripped the banana off the wall and ate it. And the act of eating the artful banana was the actual art itself. And everyone was shocked and stunned. But according to the New York Times, the stunt did not actually destroy the artwork or whatever monetary value it might have had at the moment. The 3 buyers who collectively spent about $390,000 on the taped fruit had bought the concept of the piece, which comes with a certificate of authenticity from the artist saying, yes, that's my banana that I put on that wall, along with installation instructions in case you got confused about how to tape a banana to a wall. So it's up to the owners to secure their own materials from hardware and grocery stores and to replace the banana if they wish whenever it rots. So after the second banana artist consumed the first banana, the gallery just taped another one to the wall, no problem. Incredible. Do you get it now? Do you understand the concept of art and value? You get what I'm saying, right? It's just all a huge conspiracy, this whole value idea that people just latch onto for no reason other than the fact that someone else told them that something has value. But what is value? You guys get it. You get it. So this banana on a wall as a concept sold for $150,000. Now, we're not experts in art, but I think that's in the higher valuations given to a ripe banana. But the reason it received this high valuation is because there's a low supply of concept banana art, yet tons of demand for, this unique piece of art. Low supply, high demand, high price, which brings us back to why valuations don't actually matter. They're more of a consequence of the real driver, which is supply and demand, and that's the driver we need to focus on. So if you look at this chart right here of the price to sales of the entire S&P 500, it's at a record high, meaning huge valuation. And the reason that all these stocks are at record valuations is because of this same banana concept. There's a lot of money out there that needs to be invested, and the supply of stocks actually keeps falling. And I know we're talking about the full market here, but this applies to Tesla too. Like if you look at the gross issuance of shares, so new shares coming onto the market, that has been dropping for years, meaning there's less supply of shares for people to buy. And you already know where the demand comes from, right? Demand comes from when you pump the economy full of money. So everything that Printer Powell is doing, you know, all the fiscal response to the CCPV, is putting tons and tons of money, and then where's this money gonna go? It's all demand that has to chase that supply of fewer and fewer shares. So what's gonna happen? Small supply, high demand, the price of those things are gonna shoot up. And this is why market valuations are such a useless variable in gauging the sustainability of a market trend, at least over the intermediate term. Valuations can always go much higher or lower than you think, because multiples actually have nothing to do with the durability of the cycle. Just like our banana, it has everything to do with your basic supply and demand. So it goes back to that old saying, the market could stay irrational far longer than you could stay solvent. So in the case of Tesla, why even look at valuations? Valuations aren't going to stop this thing from going up. So you can't look at the PE ratio or the PEG ratio or any of those ratios and say, hey, you know what, this is not a good idea, because that's really not as relevant here. Now, of course, it depends on your strategy. If you're sticking to a strategy where you're saying you're only buying value stocks, all right, then fine, stick to that. You wouldn't be anywhere near Tesla. And I'm saying valuations don't matter, right? But over the long term, maybe they do, but in a certain particular way. So if you're a value investor, Buffett style, and you look for a stock that is undervalued, what's the real goal there by saying it's undervalued? What you're saying is that you think you can buy this stock and that eventually the stock market will value it at a higher price. But what does the stock market need to value it at a higher price? It needs more people piling into that stock, right? You're not just going to get value for value's sake, dividends aside. You still need other people to recognize that value too. And then what happens for the price to actually move? Supply and demand once again. So in that sense, what are you using value for? You're just using it as a signal to tell you that, hey, this is a potential area where other people might start buying. You're just trying to play the player. But as I said that, you're probably thinking, well, isn't that the same case with Tesla because it's overvalued, so you think people are going to sell? No, not necessarily. That's why when it comes to value, and we use value sometimes too in our research, actually we use it a lot depending on the strategy. But anyway, the way we use it is like, yes, that is a signal. Okay, this stock might be undervalued, but we're not going to get into it until we see price move in the right direction, because price moving in the right direction is a signal that other people are actually getting in. They see the value too. And really what's happening is that there is demand coming into the stock, which is crazy to think about, right? Because most value people, they swear off any type of price action. But really, why would you want to sit in a stock that's undervalued supposedly for years and years? It's just dead money. You want to get into that thing when it's going from undervalued to overvalued. So at the end of the day, the price should still be your guide, because that's the real signal of the supply and demand. Valuations, you know, they're going to be all over the place. And that's just fine if you understand what value really is. Still based off humans and supply and demand. You could even argue that if you think something is undervalued because the price is too low, well, maybe it actually isn't valuable at all because no one else is investing in it. Even if the assets are this much and the stock price is only this much and you do all your calculations, who cares? No one's buying it. It's dead money. So you just got to remember that it's really more of a signal than anything. Now, another reason that you look at valuations, and even more than that, just fundamentals, is to give you conviction in a stock to hold it over the long term. So this is what bullish people do in Tesla too, and they say, I'm never going to sell because I've done my analysis on this and I think this is the stock and the company of the future. If you haven't done all your research, then you're never going to have conviction to do that. And in my book, with my personality and my strategy, I think that's way too risky. That's why in this strategy that I talk about in this training, we are not using fundamentals, because we're not going to hold something as it corrects 50%, as it crashes. Which is the same thing I said in the beginning of this video, right? I don't care if Tesla crashes because we'll get out, and we've already taken a lot of profits on the way up. Not saying that strategy of fundamentals for conviction doesn't work, because it does. It's just not something that I'm comfortable with doing. I'm more about price and supply and demand over everything else. It's all just fiat money anyway. Now, in our strategy that I keep talking about, we are currently long Tesla, and we've been long for a long time because we play these bigger trends and we want to hold on as long as possible until the trend bends, you know? That's when we get out. So we haven't had any signals signals to get out just yet. You can see that Tesla is still number one on our TSI scanner list. And what this TSI tells us is how strong is the momentum in these stocks. And Tesla is number one in the entire NASDAQ. And you can see we get a whole ranking here. And again, we talk about the TSI more in this training, but the point here is with Tesla being number one, there's not much of a reason to exit here. So we're going to continue to hold. So that's how we're playing it. But you know, everyone plays it a different way. And we could also look at this on more of a short-term time frame. So if you see this candle right here that happened on the 13th, it was a pretty bearish candle. So you can see that Tesla opened that day around 1660, went as high as almost 1800, but then closed lower, down by 1500. So what is that telling us? Like, what's the psychology behind that move? Because candles and shapes, they don't matter unless they're actually telling us what's going on in the psychology of these investors. So the way I would read that is that, hey, a bunch of people started buying. So much, in fact, that this thing gapped up at the open and then it shot up higher, people buying, but it hit a point where all of a sudden a ton of sellers came in. So much so that it brought it down below where it opened and it closed lower. So when you see a candle like that, what it's telling you is that there's a lot of people trying to sell, and they already did. And going forward, this area might be an area of resistance where more people will likely sell. But it gives you a hint to the psychology that maybe, hey, the steam in this move has run its course a little bit. And now, as you can see, you know, we had a little bit more of a down move after that, the few days after. Then we got a real strong up move, but look where it stopped, right in that area again. Same with the price action these 2 days. So again, it's giving you more evidence that this might be a little resistance right here that the stock price is going to have to fight with. That's when you could draw your line right there. And again, it's just a line. It doesn't have to be perfect. I purposely make them extra thick because that's how I like it. But also so that I'm not like hyper focused, like, oh, it has 2 cents over this line, it must be a breakout. No, that's stupid. So that looks like a resistance area. But another thing I see is that, hey, there have been higher lows each of these days, meaning there's buyers putting higher and higher bottoms on each day. So there's some strength coming in. So I could make another shape, pretty shapes. You know, I could make it look like this. And now it looks like a little compression, doesn't it? It looks like a little compression triangle. And whenever price compresses like this, well, then a breakout is going to happen. Will it happen to the upside or the downside? That's what you want to look for. Some people like to get in before the breakout happens. Me personally, when I was doing breakout trading, I would wait for it to happen because I would want to see the signal and then put my money in, because you don't actually know which way it's going to break. So as you can tell, I am recording this video super early. It's Wednesday, middle of the day. By the time this video actually comes out and you guys are watching it, it'll probably be Saturday, meaning there's going to be 2.5 more days of action. So will a breakout happen during that time? I don't know. Will this cute little pattern I draw just be broken by something else happening? Maybe. Either way, this could be good though, because you could kind of see how you think about it in real time and then see what happens. And then you could go down in the comments and call me an idiot if I'm wrong. That's always fun. If I had to make a bet on this, what we just look at right here, I would say Tesla is going to break higher. I believe in Tesla, but more than that, I believe in all the money that's floating around. People still want to invest, and Tesla is the most popular. We will see what happens. But again, I don't actually make plays off of this because it's too short term. For me and my strategy, the one we go over in here, it's more long term. Still has fantastic returns. We're up over like 42% right now. And that's really the benefit from being able to catch long-term trends and sitting and waiting in that trend, Jesse Livermore style. But we talk more all about that in this training. So if you haven't taken it already, there's a link in this video and down below in the description and comments. Tesla is once again the example we use. And we got a few other examples in there too. And the TSI scanner is in there too. So check that out. And if you haven't already, make sure you subscribe to this channel. We could talk about Tesla again and again and again. Maybe talk about Buffett. Maybe talk about a market crash. Maybe talk about 3 stocks. We'll see what happens, but subscribe and I will see you in the next video. Stay fallible out there. Bye.